Energy isn't getting expensive because traders got emotional. Energy is getting expensive because the plumbing is tightening and the spread is already screaming before the headline does. There's a quiet force trying to sell you the idea that crude is calm, so you're fine. And if you only watch the flat price of oil, you might believe it. But the market isn't one number, it's a chain of constraints. And when sanctions escalation hits that chain, the first thing that breaks is not the chart you were staring at. It is the ease of moving molecules through the world. Stay with me, because later I'm going to give you the simple set of signals that usually flash before your energy bill does, the level that matters most for the next 1 to 2 weeks. And the one hidden detail that makes skyrocketing costs possible even if crude looks like it is barely moving. Right now, the story isn't one dramatic announcement, it's the stacking effect. More enforcement risk layered on top of an already complicated map of trade flows, plus a calendar that resets incentives, plus a shipping and insurance ecosystem that doesn't like surprises. The result is friction, and friction in oil is a tax you don't vote on. You can call it compliance, you can call it risk management, you can call it de-risking, but the outcome is the same. Fewer parties are willing to touch certain barrels. Fewer ships are willing to take certain routes. Fewer insurers are willing to underwrite certain voyages at normal cost, and suddenly the market has to pay extra just to do what it used to do without thinking. And that's where the real pressure starts. Here's the part that tricks people. You look at the screen in early January and you see crude sitting around levels that dawn T feel like an emergency. Brent hovering around the low 60s and WTI in the mid to high 50s after a year where prices were pressured by oversupply narratives and demand anxiety. It looks contained, and that's exactly why this move is dangerous for your wallet. Because the pain doesn't have to show up first in the headline crude number. It can show up in the parts of the curve nobody on mainstream TV explains. It can show up in the prompt spread, in refined product margins, in freight and war risk insurance, in regional premiums, and in the silent decisions of procurement teams who can't afford to be wrong. But that's not the part most people are watching. The hidden detail is this. Energy costs can spike not because the world runs out of oil, but because the last mile of the barrel gets expensive and unreliable. Not the physical last mile to your gas station, though that matters too, but the last mile in financial and logistical permission. Can you load it? Can you insure it? Can you finance it? Can you clear it? Can you deliver it on time in the grade the refinery needs, in the place demand lives, without getting your ship detained or your payment stuck or your cargo rejected? When sanctions escalate, those questions become landmines. And when landmines appear, the market doesn't move smoothly. It moves in jumps, gaps, and sudden repricing. Because if this one level breaks, the math changes. So let's make it simple. Futures markets print a price. Physical markets decide whether the barrel actually shows up. Paper can be deep and liquid, especially in calm conditions, and it can give you a false sense of security. Physical is where scarcity becomes real. Physical is where I need it now carries a premium. Physical is where a few extra days of transit time or one missing insurance sign-off becomes a shortage in practice, even if global supply looks fine on paper. And sanctions escalation is a direct hit to physical flow, because it raises the cost of being involved, and it raises the penalty for mistakes. That's why you can see flat price look sleepy while the under-the-hood indicators start flashing red. And that's where the real pressure starts. Think about what sanctions actually do in the real world. They don't need to stop every barrel to change prices. Often, they just need to increase uncertainty and reduce the pool of clean participants willing to touch the trade. If you're a mainstream shipping company, you don't want your ship flagged. You don't want your insurer nervous. You don't want your bank asking questions. And you definitely don't want your compliance department to be the reason your firm ends up in an investigation. So what do? You avoid exposure. You step back. You demand higher fees. You require more documentation. You reject routes, and the trade doesn't stop. It gets pushed into a narrower channel with fewer ships, more risk, and higher costs. That channel is what people call the shadow ecosystem. And when enforcement ramps up, that ecosystem gets stressed, not because it disappears overnight, but because the margin of safety disappears. And when safety disappears, costs rise fast. Now layer in what's been happening in the sanctions environment. Over the past months, the Yusintu has continued tightening measures targeting Iranian oil networks and facilitators, and Europe has also moved to reintroduce broad Iran-related restrictions through the snapback mechanism, with wind-down timelines that ran into the turn of the year. That matters, because the calendar isn't just a date on the wall. The calendar changes behavior. When a wind-down period ends, the gray zone narrows. When a new year starts, budgets reset, compliance teams tighten, counterparties reevaluate, insurers reprice, and risk committees become less forgiving. Even if nothing explodes, the cost of doing business changes, quietly, mechanically. And that's the kind of change the market doesn't announce with a siren. It just shows up as a spread that won't relax. But that's not the part that matters most. The part that matters most is how quickly that friction reaches refined products, diesel, gasoline, jet, because those are what households and businesses actually feel. Crude is an input. Your life runs on outputs, and outputs price off a different set of constraints: refinery capacity, product inventories, seasonal demand, and the margin refineries need to keep operating. If crude is calm but diesel cracks are widening, you can still get hammered at the pump and in shipping and in everything that moves. And this is why people keep getting surprised. They think oil down means relief. But if refinery margins rise or product supply tightens, crude can be a smaller portion of the final price even as the final price rises. That's not an opinion. That's how the pricing chain works, and once you see it, you can't unsee it. So let's talk about cracks, because this is where the story becomes evidence-driven instead of emotional. A crack spread is basically the margin between crude oil and refined products. It is the market's way of telling you whether the system is struggling to convert crude into usable fuel. And if you've been watching closely, you've seen that even when crude softened over the past year, cracks didn't collapse the way people expected. An official outlook commentary has pointed to product margins staying higher on average into 2026 compared to 2025. That aspect not a guarantee of a spike tomorrow. But it is a warning that the downstream part of the chain is not relaxed. And when sanctions add to shipping friction and trade flow disruptions, downstream tightness doesn't need much to turn into a price jump. The next detail is what flips the whole setup. The next detail is time structure. If you want to know whether a move is real, stop staring at the headline price and start listening to the curve. The oil curve is the price of time. In simple terms, if the market is in contango, future barrels are priced higher than near-term barrels, which often signals plenty of supply and an incentive to store. If the market is in backwardation, near-term barrels are priced higher than future barrels, which signals urgency. Pay up now because the market wants oil today. That matters because backwardation squeezes inventories. It punishes storage. It pulls barrels out of tanks and into pipelines and onto ships. It tightens the cushion that normally absorbs shocks. And when you have a sanctions-driven shock, a thin cushion is how you get a violent repricing. Because if this one level breaks, the math changes. Now, inventories. This is another place where people get misled. Headlines will say inventories are up or inventories are down, but the real question is, what kind of inventory, where, and is it deliverable? In commodities, not every barrel is equal. A barrel that exists but can't be delivered to the right place, in the right grade, under the right paperwork, might as well not exist for price discovery in that region. That is why you can see inventory data that looks fine and still see premiums and differentials rising. Because the market isn't short of barrels in abstract. It's short of the barrels that clear the constraints. And sanctions escalation is a constraint multiplier. It turns ordinary barrels into problem barrels if they carry reputational or legal risk. It turns ordinary routes into expensive routes if insurance and war risk premia surge. It turns normal financing into delayed financing if banks pull back. That's how you get a squeeze without a global shortage headline. But that's not the part most people are explaining. So what happens when Iran-related sanctions enforcement intensifies? First, it pressures Iranian production and exports at the margin, not necessarily to zero. History shows Iran can be resilient in finding buyers and routes, but even small reductions matter when the market is already priced for ample supply. And there have been recent indications from industry surveys that Iranian output can dip when enforcement pressure rises. Second, it changes the behavior of buyers. The biggest buyers in this ecosystem often sit in Asia, and even when the barrels still move, the discounts and the routing become more complex. Third, it stresses the shadow fleet and the service layer around it. And that's the real hidden mechanism. The barrel can exist, but the ecosystem that makes it tradable becomes the bottleneck. Now add shipping and insurance. If you're moving crude through sensitive choke points, the risk is not theoretical. War risk premiums and freight rates can move sharply when tensions rise. Even without a new incident today, the market remembers. Insurers reprice. Owners demand higher rates. Some ships simply avoid the route, which reduces available capacity and pushes costs higher for those still willing to transit. And here's the part that's brutally simple. Freight is a per barrel cost. If freight goes up, the delivered cost goes up. If the delivered cost goes up, someone pays. Either the producer through a lower netback, or the consumer through a higher price, or both. In a tight product market, consumers tend to pay. That's not a conspiracy. That eyewitness how pricing power works when supply is constrained and demand is inelastic in the short run. And that's where the real pressure starts. Now, let's bring it home to what Skyrocket actually means in finance terms, without turning it into a cartoon. Skyrocket doesn't mean guaranteed straight line up. It means the risk distribution shifts. It means the market becomes more gap prone. It means your expected range widens. It means you can wake up to prices that are meaningfully higher, even if the prior day looked calm. It means volatility becomes a weapon used against weak hands. And sanctions escalation is one of those catalysts that changes the distribution because it attacks the system's ability to smooth disruptions. The system works when buffers exist: inventories, spare shipping, spare refining capacity, flexible trade routes, stable insurance. Remove buffers and you get jumps. But that's not the part that matters most. The part that matters most is what participants are forced to do. Because markets are not just stories. Markets are forced behavior. Refiners have to secure feedstock and product supply. Airlines hedge jet fuel or they eat margins. Trucking and logistics firms face diesel sensitivity. Utilities and industrials look at energy inputs and adjust procurement. Traders roll positions and manage margin. Dealers hedge options exposure. Funds rebalance. And when a new risk hits, those behaviors synchronize. That's reflexivity. It's not the narrative driving the move, it's the move changing behavior, and behavior feeding back into the move. And sanctions escalation is perfect fuel for reflexivity because it introduces uncertainty that participants can't ignore. If you're wrong on the direction of crude, you lose money. If you're wrong on the availability of product, your business can't operate. That difference matters. It forces earlier action, and earlier action can drive price. The next detail is what flips the whole setup. The next detail is that product markets often lead crude in stress regimes. Watch diesel and jet. Why? Because they're the bloodstream of the real economy. Diesel moves goods, jet moves people and high-value cargo. When those markets tighten, you feel it everywhere. Shipping costs, food costs, construction costs, travel costs. And in many recent cycles, diesel cracks have been the quiet signal that inflation pressure can reappear, even when central banks and commentators are talking about disinflation. That's why the energy story matters to macro watchers, not just commodity traders. If energy costs spike, inflation expectations can lift. If inflation expectations lift, yields can react. If yields react, risk assets can wobble. And suddenly, this isn't an oil story, it's a cross-market story. But that's not the part that matters most. The part that matters most is the calendar trigger. Early in the year, liquidity is often thinner than people assume. Funds reposition. Corporate hedges get updated. Physical contracts roll. Winter demand can still be relevant in parts of the world. Refinery maintenance schedules start to loom, and option and futures calendars create specific windows where price can be more sensitive. When liquidity is thin, the market can move farther on less volume. That's when spreads get louder. That's when stop levels matter more. That's when a single enforcement headline or shipping disruption can create a disproportionate reaction. And if you're only watching the flat price, you'll think the move came out of nowhere. It didn't. The signals were there. They were just not in the headline numbers, so what are the signals? Let's stack proof the way a skeptical investor should. First layer, the curve. If prompt spreads strengthen relative to later months, that's a sign the market is paying up for immediacy. Second layer, cracks. If diesel and gasoline cracks hold firm or widen even when crude is soft, that tells you downstream is tight or margins are being defended. Third layer, freight and insurance chatter. You don't need a perfect number, you need direction and tone. When market participants talk about rising war risk premiums, ships avoiding routes, or rates spiking on key lanes, that's a real cost input. Fourth layer, regional differentials. If certain regions pay up relative to others, that's arbitrage pulling barrels and products around the world. Fifth layer, inventories in the right places, not global totals. Key hubs, key products, key grades. Sixth layer, on-the-ground symptoms like retail availability, wholesale price moves, or procurement behavior. None of these alone is the answer. But together, they form a picture, and when that picture says tightening, you respect it, even if the screen looks calm. Because if this one level breaks, the math changes. Now, the counterpoint, this is where we keep trust. There are real forces that can cap or delay the move. Oversupply fears are not imaginary. There are credible forecasts for surplus conditions early in 2026. There are also policy and producer dynamics, OPEC's decisions, U.S. production responses, strategic stock policies that can soften the impact. Demand can disappoint. A stronger dollar can pressure commodities. Risk-off flows can hit crude, even when physical is tight. And sanctions enforcement can be uneven. Now, what looks like maximum pressure on paper doesn't tease. Always translate into maximum disruption in practice. If the market decides enforcement is more theater than bite, flat price can stay contained longer than you expect. That's why we don't do certainty theater here. We do scenarios, but that's not the part that matters most. The part that matters most is understanding the kind of risk you're facing. It's not just direction risk, it's gap risk, it's basis risk between crude and products. It's regional risk, it's volatility risk. It is the risk of being right on the thesis and still getting emotionally liquidated by the path. And that's where most retail investors lose, not because they can't read a chart, because they can't survive the path. The market will whip, it will fake you out, It will sell off on a peace headline and rip on a shipping headline. It will punish late entries. It will punish panic exits. It will make you feel like you missed it, then make you feel like it's over, then move again. And if you don't have a psychology shield, you become liquidity for someone with a plan. But that's not the part that matters most. The part that matters most is your 2-scenario lens for the next 1 to 2 weeks. Scenario 1 is the controlled pullback and retest. In this scenario, crude holds its recent range, maybe drifts, maybe even sells off on macro risk off, but the under-the-hood indicators, prompt spreads, cracks, differentials, stay firm. That's the market saying headline price can wiggle, but physical isn't relaxing. If that happens, the risk of a later jump remains because the spring is still loaded. Scenario 2 is the continuation, squeeze, and gap risk scenario. In this scenario, an enforcement headline, shipping disruption, or sudden change in perceived risk drives prompt spreads wider and pulls flat price higher quickly. This is where stop levels get hit, shorts cover, hedges chase, and the move becomes self-feeding for a window of time. Neither scenario guarantees a straight line, but one of them tends to win when the plumbing tightens and liquidity is thin. And if this one level breaks, the math changes. What levels matter? Don't get hypnotized by precision. The market doesn't care about your exact number, it cares about zones. With Brent hovering around the low 60s and WTI in the mid to high 50s, the nearby highs and lows from the past few weeks form the first battleground. If crude breaks down through recent support zones, while cracks and spreads weaken with it, that's the thesis getting hit, because it implies genuine loosening, not just noise. If crude holds support while cracks remain elevated and prompt spreads firm, that's the thesis staying alive even if price feels boring. And if crude pushes through the recent range highs while spreads accelerate, that's where the squeeze scenario becomes more credible. The key is not the exact tick. The key is what the move forces participants to do. Because forced behavior is the engine. Now let's talk about the suppression angle, because I know the audience here. You don't trust institutions, and you're right to be skeptical of incentives, but you also don't want to cross into fantasy. So here is the finance credible way to say it. There are always incentives to frame energy as contained because high energy prices are politically toxic, economically destabilizing, and market negative. There are also incentives for certain participants to lean on paper markets when liquidity allows, because paper can be pushed around more easily than physical. But there's a limit. Paper can print a number. Physical can veto that number. When physical constraints tighten, when spreads widen, when deliverable inventory is scarce, when freight and insurance costs rise, the ability to manage perception gets weaker. That's not a moral claim. It's a structural claim. And it was why you should watch the parts of the market that can be talked down easily. The spread doesn't care about a press conference. The spread cares about barrels and time. And that brings us back to the hidden detail. The spread is telling the truth. When a market is genuinely relaxed, time spreads soften, cracks narrow, differentials ease, and storage economics improve. When a market is stressed, time spreads firm, cracks widen, differentials jump, and the cost of immediacy rises. If you're only watching flat price, you're rewatching the part of the system that can be influenced by macro flows and risk sentiment. If you're watching spreads and structure, you're watching the part of the system that reflects physical pressure. And sanctions escalation is a physical pressure story disguised as a headline story. That's the trick. That's why the move can catch people off guard, but that's not the part that matters most. The part that matters most is what you do with this information, not in the sense of go buy this, sell that. I'm not promising outcomes, and nobody should. The practical value is having a roadmap so you don't get emotionally manipulated. Here's the psychology shield in plain language. Volatility is designed to make you abandon your time frame. If you're thinking in weeks, the market will try to make you think in minutes. If you're thinking in months, it will try to make you think in days. And it does that with headlines. Sanctions escalation. Then diplomatic breakthrough, then inventory build, then shipping disruption. It's a carousel built to shake you loose. Your defense is to separate trend signals from noise. Trend signals live in structure, spreads, cracks, sustained differential moves, sustained freight, insurance repricing. Noise lives in one-off headlines that reverse in hours. That doesn't mean ignore headlines. It means you don't let headlines hijack your plan. Because if you do, you will make the market's favorite donation, buying high in fear, selling low in relief. And that's where the real pressure starts. So what comes next, specifically? In the near term, the market will keep testing whether the sanctions escalation and enforcement environment is real enough to matter. You'll see it in whether Iranian-related flows appear constrained at the margin, in whether shipping enforcement stories increase, in whether insurers and freight markets show renewed stress, and in whether refiners and product markets stay tight. If cracks stay supported and the curve shows urgency, the risk of a consumer-facing energy jump increases, even if crude chops. If spreads soften and product margins relax, the story loses force, and the oversupply narrative regains control. That's your invalidation framework, not your feelings, Not your politics, the mechanics. And if you want the simplest checklist for the next week or two, it's this. Watch the prompt structure in crude and in products. Watch diesel and gasoline cracks for signs of sustained tightness. Watch any credible signs of freight and war risk premium pressure. Watch regional differentials that indicate barrels are being bid away from certain markets. And watch inventory trends in key hubs with an eye toward what is deliverable, not what is merely reported. Then overlay the calendar. When liquidity is thin, when contracts roll, when policy deadlines hit, when enforcement headlines cluster. Because the market's biggest moves often happen when positioning is vulnerable and the calendar forces action. But that's not the part that matters most. The part that matters most is remembering that even if the thesis is correct, price can whip violently against you. A correct thesis does not guarantee a smooth path. You can get a nasty pullback right before a continuation. You can get a squeeze that overshoots and then mean reverts. You can get a gap on a weekend headline and then a reversal on the open. That's the nature of energy markets when risk rises. So the goal isn't to predict every wiggle. The goal is to understand what would confirm the thesis, what would weaken it, and what kind of volatility regime you re-in so you don't get shaken out by noise. Controlled pullback and retest versus continuation, squeeze, and gap risk. Keep that lens, and you will all make better decisions than 90% of people watching a single number on a screen. One last thing, and it matters. The mainstream will keep framing this as a morality play or a political headline. That's useful for clicks, but it's useless for your portfolio and your life. What matters is the market structure reality. Sanctions escalation changes risk premiums, changes who can participate, changes which barrels are clean, changes shipping economics, and changes the curve. And when those things change, the consumer doesn't get a polite warning. The consumer gets a price tag, sometimes slowly, sometimes all at once. The spread tells you which one it's going to be. If you are the kind of person who wants to be early to the mechanics instead of late to the headline, you're already in the right place mentally. Stay anchored to structure, not noise. Stay skeptical, but evidence-driven. And if you want to be part of a community that watches the real signals, the curve, the cracks, the flow constraints, rather than arguing over narratives after the move is over, you know what to do.